You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Chris Vermeulen. His website is thegoldanoilguy.com. Welcome to the show, Chris.
Hey, thanks for having me, Jim.
Well, China has decided to pull off a Shanghai surprise, and their market closed down now 2 times in 1 week. What does that tell us about the Chinese market, and what is that going to do to the rest of the world's equity markets?
Yeah, it's it was a little bit of a surprise. I don't think people expected maybe two big down days like that. Like today, we saw the Chinese market. It only traded for 29 minutes today before the exchange hit their circuit breaker and closed down. And for a market to drop 7% in 29 minutes and everything halt again for the second time in this week, it's pretty scary. It goes to show there's huge money moving out of the Chinese sector. The Chinese stocks, the whole kind of economy play there. And, last Thursday on December 31st, I wrote an article talking about why China will bring down the world markets. And here we are 4 days later. We had the first Monday crash, and then we had today's crash in China. And, if you look at some of the leading stocks like Alibaba, their sales are down, their transactions are down, their website traffic is down. Alibaba is like the spot for people to go find products in China and source them out, purchase products. And of course, it's terrible. Like there's just no demand for that. And of course, China's GDP has been falling really since, 2007. And the average growth rate for China's GDP was about 10 or 11%. And here we are now at about 7%, and it's been under 8% for the last 4 years more or less. And it continues to decline. Chinese products are not that affordable anymore for the quality that you're getting. Sales are down globally, so there's not a lot of product being sold. And of course, we talked about this in our last interview a few weeks ago about the transportation index being down. People are not selling products, which means they're not ordering new products from China. And, the transportation led this. We saw the transportation index break down in August. It started its first technical bear market, and now we're starting to see finally the rest of the market catch on. And the next kind of early warning sign for the U.S. stock market to break down is the Russell 2000, and that's the small cap stocks. And that index is only 3% away from triggering a bear market from a technical standpoint. That's only 1 or 2 days away potentially, and we could now be in a U.S. bear market for stocks. And people just don't see that, but that's what's really happening.
Of course, the FANGs have been the darlings of the stock exchange over the past year. Are they continuing, or will they continue to be the darlings? Like
Apple and Tesla and all those guys.
And Netflix and Google, yes, your FANGs.
Yeah, well, back at Christmas time, I was sitting around the pool with some relatives, and when they were talking about stocks, and of course everybody talks about Apple and Tesla, and I pulled up the chart and I looked at the chart of Apple, and it's a terrible looking chart. It is showing signs of a top that has already taken place. It had a triple top put in place. It had a big crash there in August. It recovered. Very bearish price action overall. And at Christmas time, it was trading at $120 a share. And I said, this is going to be lights out for Apple. It's going to be probably one of the worst years for Apple because we're entering a bear market. This isn't just a normal buy the dip in Apple and it'll scream to new highs in 6 months. This is Apple's hitting major lows. It's pretty much in a bear market now. And with the bear market in U.S. stocks in general, it's going to continue to pull Apple down for probably another 6, 8, 10 months. And I've got a downside target about $68 to $70 a share on Apple. And, that's quite a haircut from $120 a few weeks ago. So, some of those big leading stocks, those bubbles are bursting and it's in free fall mode, trading down again today. Some of the other big ones are Tesla. That stock has not yet broken down. That stock, just pull the chart up here and take a look here. Tesla's got a very bearish price action. It's a very big topping pattern, and it's on the verge of breaking down. If it hasn't already started today here, it looks as though over the next month or two, it's going to have a significant breakdown. And once it breaks the $180 level, right now it's trading at $214. Once it breaks the $180 level, it's going to be lights out, and we're probably going to see a move all the way down to 105. So 50% haircut, more than that, probably in the next few months for Tesla. So some of these big leading stocks that people have made all their money on in the last few years, they're probably going to end up losing all their money because they're going to keep buying these stocks that always worked for them in the past. Just buy the dip, and these leaders will take off to new highs. And these people are going to keep buying the dip, double down, triple down, quadruple down, blow their account up. That's what happens in bear markets. They don't realize there's been a shift. You can't buy dips anymore. You have to short the bounces and cover your short positions on the crashes. It's a totally different game, and people just don't know how to change gears. So those traders who trade those leading stocks have made a fortune to the long side. If they haven't played a bear market before, they're going to be in for quite a surprise this year.
Well, with Tesla, yes, it's the high-tech darling, but people who ordered cars from them 4 years ago have yet to receive them. They had a major recall. If you just looked at little things like that, you would have had a good hint. Maybe Tesla isn't the hot thing that people say it is.
Yeah. There's a lot going on. And overall, though, when you look at the whole cycle, like if you even look at the stock chart, it's kind of been playing out over 2014, 2015. You could just see the excitement in the stock has faded. There's been some very heavy selling taking place, and it's just not having the same moves that it used to. The price action, the mentality for traders, investors there, big money players, has shifted, and you can tell it's not a momentum stock anymore. It used to be heavy momentum. It would scream to the upside, have a super sharp pullback, scream to the upside. It would do this over and over again for a couple of years. And that whole price action has changed. Now it's a grind. It's very choppy. It's very noisy. There's high volume spikes on the down days, big price gaps. That's the sign that the game has changed. It's not a momentum play. It's in distribution phase, meaning big money players are unloading large positions slowly, getting rid of their blocks of shares. And now it looks like that momentum is just about to shift to the downside. It looks like it's going to be a great short play for this bear market. And I don't think a lot of people are expecting it, which is why it's going to be one of a very strong move, in my opinion. It'll be a strong downdraft.
Well, what I heard from people like Mike Swanson is you should have been taking a look at who's been trading stocks over the past year. All these CEOs who are being paid in stocks were selling them off as fast as they could. They knew this was going to happen. Yeah,
and that they made a lot of CEOs, believe it or not, the timing for a lot of CEOs is way out of whack from where a market's where there's a bottom in the market or a top in the market. But obviously some of them are much more sophisticated. I think a lot more people now compared to 10 years ago have started to focus more that there is a technical point of view for the market. It's not just fundamentals. You can start to use technical analysis to try and time your exits if you're a corporate. You've got shares and options and things. So it's definitely an important part, but it makes you also wonder if these guys are dumping shares of their stock. What do they know that we don't know? Usually it's never been a good sign when CEOs are dumping shares of their stock, and who knows what's down the line for Tesla, right? It's usually you don't hear about the bad news until prices already dropped, and everything is setting up for a huge drop in Tesla. CEOs are selling their shares, and we're going to get this big sharp drop in price, and then about a month later, a week later, the news will come out that, this bad news has been pending and they've been working through it. Something big is probably brewing. So that's kind of usually what happens.
Yeah, and also if CEOs start to refuse to accept stock as payment, they want cash.
Yeah. A lot of times when they receive stock too, they've got a lock-in payment. They can't sell it for a certain amount of time, and anybody who is been following the markets and cycle analysis, nobody wants to be to get paid in shares, or I wouldn't want to be getting paid in shares knowing you can't sell them for 6 or 8 months, which could be the market low. So, that is definitely a red flag. And, there's the whole financial sector and energy as a whole here is really starting to kind of break down. And surprisingly enough, we're not seeing money move into bonds. Bonds really aren't having a significant move yet. And I talked about this with subscribers to my newsletter yesterday, I think it was, that until we see bonds start to break out of this little bullish pattern, we're not going to see the bear market hasn't really grabbed hold and people aren't in true fear yet. And right now the bond market has been consolidating in this huge pattern, this bullish pattern from pretty much January of 2004. So the last 2 years has created this very strong bullish pattern. And even though we have these big down days in the market this week, we're not seeing bonds move up and really start to make any higher highs on the chart whatsoever. Even on the short-term charts, it's staying very consolidated. And that goes to show that investors are buying the dip. They're not moving. They don't want to just sell their stocks and go into bonds. They're not actually truly scared yet. So when we start to see bonds move up, that is when we see true fear in the market. And depending on the bond you're looking at, that kind of signals where we are in the whole cycle. Long-term bonds like the TLT ETF, they generally won't truly spike and rocket in value until almost the midway or two-thirds of the way through a bear market when everybody finally throws their hands up and says, I am done with stocks. But if you look at the short-term bonds, the 1 or 2 year bonds, they usually will start to move first. And they've started to form a bullish pattern that we've seen before, but they haven't even started to move yet. So where the U.S. stock market, to me, is right at the starting phase of a bear market. A couple sectors are already in the bear market. And, this is going to be one of the best times to get short for looking forward 6, 8, 12 months. And nobody else, the average trader or investor is not positioned for it yet, which is great because you want to get positioned first. And then when they all start to panic and sell, the prices drop and you make money from falling prices because you're going to have positions in place that profit from falling prices. So we're really at an awesome point in the financial markets for people to really change their financial outlook over the next 12 months in a big way.
We'll have more with Chris Vermeulen right after the break.
Unbelievable harmonies, spectacular performance, the ultimate tribute to the Everly Brothers and Simon & Garfunkel. Bird Dog and the Vintage Electric Band, Saturday, January 9th at the Alex Goulden Hall. Buy online and save at ontourtickets.com. More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600.
Welcome back. We're speaking with Chris Vermeulen. Chris, have your phone lines been ringing off the hook from clients who are concerned about the falling markets, especially, well, I guess around the world?
Yeah, everyone's getting really nervous about this falling market. Believe it or not, I don't get a lot of phone calls from people so much concerned. It's usually I'm talking about this bear market slowly unfolding and how the market is coming into a year-long crash type of thing. And a lot of the subscribers I have, they write, nice emails saying, I agree, this makes sense. They share their articles. The phone calls that I get are usually people saying, stop screaming, the sky is falling, it's not going to happen, blah, blah, blah. I find it funny that the people who are so against it are the ones who go out of their way to make the phone calls and to really voice their opinions. And usually, when you can tell they're very emotional and they, usually when somebody's really emotional, it's usually the wrong, they're usually going in the wrong direction because they're positioned incorrectly. So it's going to be really interesting going forward here this year. But I think most of my subscribers, because we've been talking about this top forming since 2014, and it's just maturing really as of this week. We're starting to see the major indexes starting to test this key support zone where we're about to crack into a stage 4 decline, which is a bear market. And, we've been waiting for this for a long time because 2014 and 2015 have been extremely difficult years for traders and investors. 60-70% of stocks are trading sharply lower. Meanwhile, the indexes are trading up near all-time highs. And most people carry a basket of their own mix of stocks, and they're losing a lot of money even though the indexes are trading up. And, it's just been that style of trading where it's very tough, just like I mentioned in Tesla. It used to be a momentum play when we were in a strong bull market. The last 2 years have been nothing but sideways chop. You got to pick the hot sector, you pick the hot stock. Very hard to do. And now we're getting to a point here where most, breakouts aren't working in stocks. You can't just buy a breakout unless it's a breakdown. You can't buy the dip. And this is going to be the year to be net short, buying inverse ETFs that rise in value as the stock market falls. And it's really the best play that's out there.
I was going to say the stock market is just like the classic thing about any disaster. They say there's certain steps to it. There's denial, then anger, then trying to bargain, and finally acceptance, and then action.
Yeah, exactly. And I use bonds, which I just explained, to kind of gauge where those investors are. And right now, everybody's kind of, they're anxious. They don't know what's going on, but they're also in denial. They're not selling their positions. They're not moving into a safe haven or anywhere. They're just continuing to slowly buy bonds, stocks. And so the bonds, to me, especially the different, the 2-year, the 10-year, the 20+ year, they give you a good feeling of what the average person's mind is at, if they're in denial or not. And of course, we're right at that early stage where nobody really sees it yet. Nobody's really worrying about it so much yet, or they're not committing to the bear side. They're going to just continue to hold that basket. They're going to hold that bag of stocks until the bottom rips out. And then they're going to realize they were holding junk, and why the heck were they doing that? But that hasn't happened yet, and we're slowly getting positioned to do that. And subscribers of mine, we've been short the Chinese market for a little while here, and these falling prices are really nice to see. And the Chinese market was kind of the first. Transportation sector in the U.S. was kind of second, and now we're looking here, at the Russell 2000, the XLF, which is the financial sector. It's about 3% away from having a technical breakdown, and wherever the financials go is usually where the rest of the market goes. And once the financials start to sell off, they're going to become a hot commodity. They're usually heavily traded, and we could see, the whole market really roll over once the financials start to break to the downside.
What does this all mean for gold and oil?
Well, gold and oil have been, they've both been under heavy pressure recently. In the last couple of days, we've seen gold really kind of jump in value as a safe haven. Same with silver, but nothing too significant. If you were to zoom way out on the chart several months, this is nothing but a quick kind of short covering pop, a little type of fear play. People are fearful, so they're jumping into a safe haven. They want physical assets. So we're seeing a bounce in gold and silver, and I don't think we're going to see the bottom in gold and silver, or at least a confirmed kind of uptrend here for another couple months. That being said, the bottom here might be in gold. If the U.S. stock market does break down and sells off January, February here, then I think that could be enough to hold gold and continue to push gold and silver and miners up to a level where it'll break that downward momentum, and will be technically in a sideways or bullish pattern where we might start seeing buyers continue to move into that as opposed to sell into these rallies. So the precious metal sector is still in a downtrend. It's having nothing more than a pop. And until we see a basing pattern and some real strength there, to me, I'm not a huge fan of jumping in to try and catch that play. There's a lot of work that needs to be done for gold and silver before the bottom's put in. Oil, on the other hand, it's been under some serious pressure. It's still about 15% away from where I think the bottom is. Right now it's trading around $33 per barrel. And I've got a downside target, which we talked about in our last interview, about $27 per barrel. So we got about 15, 16% to the downside to go. And then I think we could see crude oil struggle down there for a little while and trade possibly between more or less the $42 and $27 range for a few months there. But overall, most of the downside is done for crude oil, but it's going to be really volatile here for several months until it firms up, creates a basing pattern or a bullish pattern, and then can start moving up. But again, it's still very weak here.
Well, one of the insiders in the energy business said he thought oil could go up, say around $60 a barrel around June, considering that so many Americans have bought giant SUVs that are going to start sucking up gasoline like you wouldn't believe when the driving season starts.
Potentially, I see most of the usage being done in air travel and transportation, and of course, looking at the sales and the GDP for China and sales even in the U.S. and Canada, everything is falling. Those huge freighters, all that stuff, that's what really sucks up a huge amount of fuel. Obviously, if we start getting into any war issues, oil will skyrocket. with all the oil required, and of course everything else related to where it is overseas and where the war is and stuff. But the oil has dropped so quick, and you can always get a snapback move. Like really, the first reaction high from here, if we see a short covering rally, will bring crude oil right up to $50 per barrel. And if it has any more strength, it'll pop right to around $60 per barrel really quick. It could do that. And that's a big range it could trade in. It's between 60 and, this $27 and $23 where it is now. It could trade really choppy up and down in that big range for several months here. And then when it breaks out of that range, it'll probably move all the way back up to somewhere around the $90, $95 per barrel. But it's going to be a really volatile play. And until we start to see some stability in there, when we start to see a basing pattern, a real critical kind of breakout zone, that's when you really want to get involved. Jumping in with all this noise and this range is really tough stuff to do.
Right now, you'd have to say the markets are in a condition where if you snooze, you lose.
Yeah, it depends what you're watching. I was talking with a subscriber this morning, and he's kind of wondering, well, what's the best play? Can we get into gold? Let's get into gold. And I'm like, well, technically gold is still clearly in a downtrend. Gold miners are underperforming physical metals, which is never a good sign. There really isn't, a good spot in precious metals, in my opinion, yet. The stock market looks terrible. You don't want to be owning stocks. Real estate is most likely going to soften up as we go into this bear market. There's some good plays in real estate, depending which way you go about things, but the best play that I see is either cash or you short the stock market to make money when it falls. Those are the two best options. Do nothing, go to cash, sit pretty, let everybody get slaughtered, or short it and profit from everybody in panic and sell-off. It's the best return on your money, I think, is to buy an inverse ETF that rises in value as the stock market crashes. And the prices fall 3 to 7 times faster than they rise. So in a 1-year bear market, we could make all those gains back that the last 7 years of higher prices has created. And we've seen this happen over and over again. And if you use a leveraged ETF, you could make, 3 times more. It's wild. And really, it's the only good play. Like, I don't see any good play right now as of this week other than preparing for long-term shorts on the market.
Chris, thanks a lot for chatting with us.
Hey, pleasure to be here, Jim.
And I'm sure interesting times await us.
It does, for sure, yeah. We're going to be in store for a very wild first quarter of 2016.
My guest has been Chris Vermeulen. His website is thegoldandoilguy.com. You're listening to HowStreet.com radio. Find us on Twitter at Talk Digital Net. Our popular YouTube channel is Talk Digital Network. Comments about the show can be sent to info@HowStreet.com. I'm Jim Goddard. Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.